Well, we've kind of highlighted a lot of the skills that you said transferred over, but one thing that we haven't really mentioned is that you are now the EVP of Cardone Capital nowadays. And so we've heard from your early days and what it was like, but what is your role nowadays in the business? Because obviously things have really exploded since your time at the beginning of this.
Well, now I run Cardone Capital with Grant. So I run Cardone Capital, and Grant is a phenomenal partner. And what has happened. I mean, a lot changes in 9 years. I think if people look back at what we've done, and this goes back to crowdfunding as well, right? Because now Cardone Capital, we're a crowdfunding platform where we go and find deals. We have our own platform, so we don't use a lot of these third parties, and we've been really successful just going straight to investors who are looking to invest in multifamily real estate. And we've really built out a done for you platform where we got great, beautiful, awesome deals, and we offer them to retail investors. We've raised almost $2 billion in capital, and our portfolio is $4.3 billion. And look, a lot of our deals are great assets, great locations. And so, my day to day has changed a lot as we continue to grow the portfolio, but I'm always still very curious, and I'm always still learning. And now the team's different, the deals are different, they're bigger deals, but it's really the same thing. And I always go back to this: the people that we have on our team are phenomenal. The thing that I'll tell people, if you're just getting started in real estate, you don't have to have a big team. You have to have really, really good third parties, meaning third party attorneys, third party property managers, third party bankers. Like, you just have to have good people around you.
Yeah, so it sounds like you're buying a lot of multifamily. Can you tell us? I mean, obviously your experience as a pilot. How does the pilot's checklist apply to buying large multifamily as you sort of go down this route?
Well, the due diligence checklist on multifamily is a lot bigger than my checklist as a pilot.
Yeah, I believe that.
And the checklist goes for the debt, it goes for the deal, it goes for the investors. But it's all transferable. Like, and this is what I always say too. Like, it doesn't matter if you're in a corporate job or if you're a pilot, or because really being a pilot is really like a corporate job. Like, everybody who has a skill set of either being a leader or managing a team, you can become a great real estate professional by transferring those skills. So yeah, look, I look at a lot of deals, and I look at a lot of markets. And so again, all of this stuff that I was telling you about earlier is like, I've been to a lot of markets. I've looked at a lot of deals. I've looked at a lot of deals with Grant. I've learned from the best. I was literally with Grant, and this is what, maybe people didn't pick up on this. I've literally been with Grant for 9 years, but for the first 6 years, David and Rob, I was with him every day. Like, I was with him every day because I was flying. When we were not flying, we were looking at deals. When we were not looking at deals, we were flying. When we weren't flying, we were looking at deals. Everywhere we would land, we would look at deals. And when we were overnighting somewhere, typically I would stay with them.
By osmosis, you're observing the framework that Grant sees the world through, the problems he's anticipating before they come. And there's a lot you're learning in your subconscious. You're like, oh, I didn't think that was a problem. Or he sees opportunity where someone else wouldn't. Or he sees, in order to take this deal down, it's different than the last one, and that here's where the challenge is going to be not there, which now gives you the empowered ability to go out there and say, let me fix that, which makes you even more crucial to him. And that's the secret. If you want someone to become a partner with you, whether it's romantic, whether it's business, whether it's friendship, whether it's anything, make yourself such a crucial part of their life that they can't live without you. I mean, that's really how you take leverage in a relationship.
Yep, it really is, David. And then also you layer that with the rules that are changing, because before 2014 and 2015, you actually couldn't do general solicitation, which is the way you raise money. And so as we're building this foundation in the real estate, 2015 and 2016 happened, and now the SEC, they started allowing us to go and do general solicitation. And so all of the business owners, all of his friends, all of his power base were reaching out and saying, hey, I see you guys are doing deals. I want to invest with you. Like, Cardone Capital actually started because we did one deal that was $20 million. The debt was 14, the equity was 6. We raised a $6 million in 7 days. And Grant looked at me and said, hey, can we do this again? The next deal was 40 million. So like, all of these things, like you can't just look at Grant and Ryan and Cardinal Capital like, oh, these guys are overnight successes. We literally built this thing in gradients, and I highly encourage people that are listening, you can do it too.
but you brought a skill set to the opportunity. That's just where I really want to like plant my flag here. You didn't bring nothing and say, turn me into a superstar and then get frustrated when it didn't happen. You had already done some things in life and you brought those to the opportunity, and the opportunity helped you flourish.
And I was investing in the deals too, David. So like I was at lunch one day with Grant in Chicago, and I started showing him my 21 units. And he looked at them. He's like, man, these are junk. And I was kind of offended at first. I was like, well, what do you mean? I was like, this is the eightplex. This is a single family homes. Like, this is good to me. And he's like, Ryan, he's like, look at what I'm buying. And I'm like, well, what would you recommend? And he's like, I would sell them all. And I was like, you would sell them all? I went home the next day and I sold them all. I called Eddie, the real estate agent. Like I called David. I was like, sell them all. And within 30 days, because I mean, Scottsdale was a great market. Within 30 days, I ended up with $500,000. I couldn't 1031 because Grant had already bought the deal. Like we do, like he buys the deal and you could roll your money in. So I paid the tax of $100,000, but I literally took $400,000, David. And this is really what, you said, I'm putting my flag in. I took my $400,000. I invested it with Grant in 826 units in Nashville, Tennessee. And I said, I am committed to doing this. Not only am I going to time, energy, and effort, here's my money. And within 3.5 years, that $400,000 turned into 1.1. And Grant, I tell this all the time, Grant actually made me a millionaire. And I'm the first millionaire from my family. And I'm really proud to say that. And it's been life-changing working for somebody. It's been life-changing working for Grant.
I'll bet you what Grant saw when he looked at that was the return on equity was very poor, where you were probably looking at the return on your initial investment. They had appreciated to the point that the cash flow was not keeping up with how much equity you had. So he saw the inefficiency of your capital. You put it into a new deal with a value add component and stronger cash flow. And so you turn that equity into something that would give you a higher return.
And I didn't have to work in the day to day too. It's so it's like I went from 21 units being the manager, because we all start there, right? And I actually encourage people, do it, get a 4plex, get an 8plex, get 12plex, get 32 units, like do it. Because the worst thing in the world is not doing anything. And then now you have no assets. All you have is liabilities.
And sometimes it takes time. Sometimes, like right today's market, you're not going to go out there and crush it and add 6 figures to your net worth buying a fixer upper that nobody wanted that you found on Zillow. You may have to wait a significant period of time to build that equity up to go do what you did, but still it's better than not doing it, right? It doesn't make sense to cry about how easy the market used to be, so you're not going to invest. Well, this is what the market offers today. So how do you build a strategy around that?
Yeah, because as you buy these assets, they will over time. I truly believe, if this is my strategy is, 5, 7, 10 years, even longer, you buy the best real estate, you buy great real estate that you want to hold for a long time. You don't just buy the real estate that's on a discount, because my first deal was on a discount. I made the least amount of money on it because of the location, because of the market. The third deal that I bought, I actually paid the most, but I made $100,000 within 12 months because of the location. It was so good. So it's interesting. Like as I did my first deal, second deal, third deal, fourth deal, I started learning. I started picking up on these different pieces where I was like, man, I want to go and invest in that market because the appreciation and the cash flow is better. I don't want to just go here because it's a discount.
I'm working on a book like that right now.
Let me and Rob be the co-author on that book, okay?
That's right. I'll write the foreword.
Rob did write a foreword once, and it was rejected. Nobody wanted it.
It will be a foreword.
A foreword. Ryan, you mentioned that you've seen a lot of deals. You've underwritten a lot of them. And I understand you now have a 2-minute process to underwrite a deal. Can you tell us what that's like?
Oh, yeah. I mean, so look, day one, when I joined Grant's team, he used to underwrite a deal. I used to tell him 2 minutes. It's actually like 43 seconds. But I'm like, man, if I could underwrite a deal like Grant, then my whole life would change. And so literally what I do, and as you get spooled up, you start learning these markets, right? And in multifamily, what I do is I just take the number of units times the rents in place, not like what the broker's telling me, in place rents. And then I just use the occupancy of like 94 or 95%, depending on the marketplace. And then I just use rough numbers like, okay, my expenses typically in Florida on the East Coast are between 40 and 45%. On the West Coast are 30. And so this is what my NOI is going to be based on. Here's the income minus the expenses. Here's my NOI. And so I can solve for, like on these bigger deals, they all trade at a cap rate. And so I literally can underwrite a multifamily deal, 300 units within 2 minutes. And it gives me so much power because now I'm communicating to the broker that I've got, number one, speed. Number two, I know if it's a good deal or a bad deal. So I don't waste a bunch of time on bad deals. But I've learned that from Grant, and I highly encourage people, if you're listening, learn how to underwrite really quick, identify bad deals, move them away from you as fast as possible. So that way you could focus on really good deals.
You know, I got to give you some props, man. I've been asking every single multifamily operator that I know for something like that for years. And none of them will, because if they leave their spreadsheet, they get separation anxiety. They can't handle it. We have that with single family houses. It's called the 1% rule. It basically, you throw out everything that isn't, it doesn't have to be exactly that. It has to be close to it. And then as interest rates are low, you can get further away from a full 1%. But as they go up, you got to get closer. And then I also learned that the higher price the asset is, the less dependent it is on the 1% rule. So a 50,000 house better rent for $500 a door, but a $900,000 house doesn't have to bring in $9,000 a month just to cash flow positive. We're not saying it's a good investment, but that's because I've seen enough of them that those patterns jump out. And you're basically saying, I've seen enough of these houses that I know expenses are X over here and Y over here. And it all goes in the algorithm of your brain. And you could spit out an NOI that lets you say, all right, if we're trading at a 6 cap based on this NOI, hey, this is the ballpark we're going to be in. Can we play ball? And if they go, no, it needs to be something. All right, we're done. We're moving on. Not running it through a 3-hour process of putting it into a spreadsheet.
You're so spot on, David. And also the 1% rule, I still use it in today's market. Like I looked at a deal today. It was 140 units. They wanted, it was like 240 grand. And, rents were, it was like $1,900. And so I'm always looking at that 1% rule, because I always know that if I can meet the 1% rule, I'm going to buy every deal. If a unit's 100 grand and I can get $1,000, I'm buying it. Put it under contract, write an LOI. Let's move on. I'll figure out the expenses, all that stuff later. But I just know, and also the bigger the deal gets, the less you have to be to the 1% rule.
Same thing else, but you have a little bit more slack when it gets bigger
because you get economies of scale.
Can you just define the 1% rule for anyone at home that doesn't know exactly what that is?
Yeah. So if I buy a house for 100 grand, I need to get $1,000 per month in rent.
Gross, not profit.
Gross.
Awesome.
Well, it's encouraging to hear that applies at the unit level of the apartment complex. So for clarity's sake, we're not saying if you buy it for $100 million, it doesn't mean it has to bring in $1 million every single month. What we're saying is the door count here. If it's bought for $100,000 a door, if each average rent of these units is $1,000, it's worth putting through your analysis and looking into deeper. That's where you're saying, write the letter of intent, get that thing under contract. Let the guys then start to the bean counters kind of identify all the exact measurements, make sure that it's a property you want. But if it doesn't, you're throwing that thing out right away. That right there is very, very useful.
If it is 100 million, I'm just trying to understand why the 1% rule wouldn't be like proportional. Wouldn't it still be, if it's $100 million building, you would want it to bring in $1 million gross?
I feel like in multifamily, there would be there's more expenses to take into account than there are with single family, and there's more income sources, right? So with multifamily, you can have income coming in from laundry, from parking, from storage. Like, it's not just the rent versus with residential real estate, your only income sources.
That's true, though. That makes sense. Yeah.
When we're spitballing how something feels to us, it makes sense in our head. But if you have to articulate how you got there, you almost got to pull apart the algorithm of your own brain to be like, why did I think that was a bad idea? And hopefully there's actually logic behind what you said. But a lot of like what you're doing, Ryan, when you've looked at so many deals, is it will stand out like, oh, that just feels like that's probably good. You don't know why. You couldn't explain it. But when you dive in deeper, you'll be like, oh, that's why. There's inefficiency here. They could bump rents much more than what they realize, or insurance is much higher than what they thought. So they're not going to get this much money. Sometimes you don't know exactly why it feels right, but you know that it does.
Yeah, exactly right. And to your point, David, like the income and the rent is one thing, but then you also have like utility reimbursements. You got other income, and those are really big numbers on multifamily. That's why it doesn't have to meet and match the 1% rule on like the door count. But what I was going with that too, David, is also like knowing the numbers quick. It allows you to be the captain. It allows you to be the guy now in these bigger deals where you have confidence, where you could actually start using crew resource management, which is team resource management, which is actually the broker. Hey, what numbers did you come up with? Hey, what are you showing for the going in yield? Hey, what are you showing debt guide? Like I think people overcomplicate multifamily, and really what I want to instill is saying, hey, look, know the numbers really quick, so that way you can communicate with the brokers with confidence. That way you can communicate with the debt with confidence, because the bigger the deal you get, the more partners you have. And this is actually a safeguard in these bigger deals, because the debt's going to thoroughly look at the deal. The broker, my competition right now is these big institutions, whether it's Blackstone or Starwood, or you can go down the whole list. These guys are very, very professional, and everything has to check a box. So the sooner you guys can get to these bigger deals, the less risk or the less chance of missing something actually occurs, which is crazy to think about.
Man, that is kind of nuts. At what point, just out of curiosity, at what point will you be a big institution? I mean, you guys are growing at such a fast pace.
Well, look, we slowed down our buying over the last 8-10 months because of this shift. We think that there's going to be a huge opportunity in the next 12 to 24 months, especially as debt and maturities and where interest rates are, to buy assets at a great basis. What I mean by that is if you can buy a deal for $225 a unit and it costs $300 with inflation and everything else to build, we think that long term over 10 years, those are great buys. But look, we're competing with them now. It really is just a function of how do you grow and scale the correct way. We're not in a hurry, but we know we'll get there. So we're just really patient. We are very conservative. I know a lot of people look at Grant, Cardinal Capital. Instagram is one thing, but when he goes and invests in money, like Grant has a lot of money invested in these deals. Like he literally takes his money, invests in these deals. For me personally, all my net worth is invested in these deals. So we know what will come. It's just a matter of time. And the cool thing about it is we're doing it with retail investors. We're doing it with partners. Like when I say retail investors, this is just everyday folks. This is just like me and my family and David and Rob, and like there's no middleman. So it may take a little bit longer, but when we do get there, it's going to be together, which is super awesome for us.
It's amazing, man. What a journey. What a journey. I'm excited. I want to connect with you after the podcast for sure. But we got one more segment for you. If you're willing to indulge us, we call it Flight, Fight, or Fright. And we have 3 questions for you that we want you to answer. That's each one of those words. Is that cool?
What is it? It's fight, flight, or fright?
Close. It's it's flight, fight, or fright. Okay, we're gonna send you some rapid fire questions here, all right? So first one, fright. What are the fears you had to overcome to get where you are?
I had to overcome the fear of failure. When I first started working with Grant on that 15 units or the 40 units in 40 days, I was actually terrified because I was like, what if I fail? I won't have the opportunity. But I did it anyway.
All right. Flight. When do you know to walk away from a deal, a job, or an opportunity?
When the numbers don't make sense and there's no more growth.
Okay, last one. Fight. What were the hardest lessons you had to learn in real estate?
The hardest lesson I had to learn was not doing it myself. So the hardest lesson that I had to learn was like in my mind, my dad always taught me that I want to control 100% of everything. The hardest thing for me to undo was that partnerships are really, really good, and they actually accelerate what you could achieve if you partner with the right people.
Awesome. I like that. David, that's kind of like a mental or like a mindset deal deep dive almost. It's like the mindset version of it.
And Ryan, you gave awesome answers. It's almost like you've been training for this.
And I didn't even have those. Nobody even prepped me for that. That was kind of like random.
Well, thanks, Ryan. This has been an excellent show. We covered how to get started with the advice that you have. It doesn't have to be perfect. So your uncle gave you some advice for how to get you going in real estate. You built a portfolio that eventually Grant Cardone told you was crap, but it doesn't matter because that crap got you to a point where it could even be called crap and you could put it into something better. We talked about the right way to reach out to somebody, and we gave kind of a framework for everybody that's trying to get an opportunity. I hate the spaghetti against the wall method. Just send a bunch of DMs and hope that something sticks. Actually come with something feasible that you're proposing, and be humble. Like you said, just I'll work for free. Let me prove my way. But if you get in the right environment, that will get you to the top. You're now running Cardone Capital. Like if that's not a great example for everyone to follow, I don't know what is. We talked about underwriting deals quickly, right? Not getting too caught up in the mess. That does not mean that you're going to buy a property based off of a 43-second underwriting system, but it does mean that you're going to get your foot in the door and that you can move with the power players. Those brokers are trying to figure out who's legit and who's kicking tires. And you kind of put yourself as a front runner in that situation and then take some time to analyze the deals. And we talked about buying properties, thinking about the future, not just right now. What do you expect rents to do in that area? What do you expect jobs to do do in that area? Is there going to be more supply coming in, or is supply somewhat constricted? When we had Grant on the show the first time, he actually talked about how he likes to buy in liberal areas because they are less likely to issue new building permits. And it's a way of kind of eliminating competition. It's a different way of thinking that your typical investor that just runs it through a calculator and says yay or nay isn't taking into consideration. Rob, anything you want to add there?
No, you covered every single thing. And just going back to your thing about, people reaching out and everything, you mentioned getting your foot in the door. There's this old adage back in the day, or this old kind of urban legend of this guy that really wanted to work at a very prestigious ad agency. And so what he did is he sent a shoe to the creative director with a note that said, I just wanted to get my foot in the door. So I just wanted to know, would that work on you, David? Do you think that would be a way to get through your DMs if everyone just sent you a shoe?
No, that's the opposite of what I was just saying. People, come with a plan. Don't try to be cute. Don't be like, I'm so clever, I sent David a shoe and I get the shoe and I'm like, well, now what do I do with you? Like, it always sounds good when you hear the story and it just turns into a Cinderella tale. But no, that's not, unless inside the shoe you have a business plan and you tell me what your skills are and say, give me a shot, I'll do this thing for you, and then you can see how it looks. All right. Well, thank you, Ryan, man. This has been fantastic. I really enjoyed getting to know you, and thank you for sharing things. Where can people find out more about you?
Very easy. Social media, Ryan Secco, YouTube, Instagram, cardonecapital.com. I mean, I'm very out there. I'm very open. I typically give people my cell number, but I'll leave it for the social media and also the website.
And Secco is spelled Tseko. So that's RyanTseko. Go give Ryan a follow. Rob, how about you? Where can people follow you?
Oh, you can find me over on Instagram or Threads or YouTube at Robuilt, ROBUILT. I teach people how to do real estate, Airbnb, short-term rentals, investing, life, liberty, the pursuit of happiness, and everything in between. What about you, David?
Find me at David Green 24 all over social media, including Threads and Instagram and everything else, or at David Green 24 on YouTube. My website's davidgreen24.com. So thank you for saying that. My social media used to be pretty boring, I will admit, but it's been stepped up quite a bit. So
it's fire now, my friend. You have done it.
Absolute fire. If my social media had a glow up, it would be Ryan going from a pilot to Grant Cardone's pilot and now running Cardone Capital. So just like you don't want to miss out Ryan's story, you don't want to miss out on my social media. How was that, Ryan?
So basically, David's social media is the Ryan Secco of social media.
That's what I'm saying. Yes. Thank you for clarifying that. This is David Green for Rob the Fire Hydrant Abasolo, signing off.